Basically, trying to put money into certain products or certain item to get a return from it. That is investment. So what is investment? It is the addition of capital stock of the economy. Addition of capital stock into the economy. That means capital stock could be factory, could be stocks, could be machines, buildings, whatever we're adding up to join that economy is investment. So I'm coming up with my own office, I'm coming up with my own business. I'm adding up to the investment of the economy. So each business is added up to different investments that brings up the economy. So that's what investment is about. You spend money on capital goods instead of consumer goods. That is investment. Spending on capital goods is clear. So this implies to factories, machines, offices, stocks used in producing other goods and services. So when you invest in capital goods, you are investing on goods that can produce other goods. That is investment. Clear, right? So we have to start from investment. We have the gross investment and net investment. We're talking about gross investment. Here we're talking about the additional capital that is being produced. There's additional capital. Oh, this is an additional machine that will be used. We'll use it in place of one machine that is done, that is depreciated, and another machine that is still working. That is gross investment. You are producing a machine, or you are producing additional capital to replace the used capital or an existing capital. That is gross investment. Do you get gross investment here? Production of additional capital to come in place of a used capital which is depreciating and an existing capital. That is what?
Did you say one time?
Yeah, sure. Gross investment is production of additional capital stock to replace the used capital stock, that is depreciation, and existing capital stock. That makes gross investment. Then we have net investment. For net investment is gross investment minus depreciation. Here it's gross investment. What we have here minus depreciation. What we have here, the additional investment, the additional cost, capital stock that have been produced, with the one that has depreciated and the ones that are still in existence. That gives us gross investment. But for net investment is the stock we have right now minus depreciation. Clear, right?
Yeah.
Then we have investment in human capital and investment in physical. That is capital investment. There's human investment and capital investment. Why do we call it human capital? We call it investment in human capital because it means we are investing in education and training. That is investment in human capital. Do you get human capital?
Yeah.
That means they are investing in you through training or education. Then we have the physical. Here we are talking about investment in investments. These are the determinants of investment. We're talking about those factors that warrant us to invest or that stops us or discourages us from investment. Number one, or investment. Number one, the rate of interest. We talk about the rate of interest. Here I wrote some investments are financed with borrowings. Therefore, the rate of interest has been determined the level of investment. Low interest rates encourage investment as it will become more profitable, while high interest rates make investments through borrowing less profitable. If the interest rate is low, people will be able to get money at a cheaper price, at a cheaper rate. That means you can borrow a lot of money for investment. At that point in time, your return on profit, your return on investment will be high because the cost of borrowing is less or cheap. Do you get the point here? If the cost of borrowing is cheap, is low, that means it's low, it means you are able to borrow a lot of money for investment at a lower rate to make more profit. In the other case, if the cost of borrowing is high, to borrow a lot of money for investment becomes a high cost for firms. At that point in time, their profit margin will be less. They won't be motivated to borrow. Do you get the point here? If the interest rate is lower, firms will be able to borrow a lot of money for investment because at that point in time, the cost of borrowing is cheap, the profit on investment borrowing will be high. Retain profit. This is the savings that firms give. The higher the interest rate, the lower the investment on physical goods by firms. Retained profit is the amount of money you have kept that you want to put back into the business, that you're not giving to the owner of the business. But you have to save it, yes or no? So in the course of saving it, what determines if you have to save it or not? It's the interest rate. So if the interest rate is high, your retained profit will be saved and you earn more interest. So this will encourage you not to invest in physical goods, rather to save more. So firms will not be able to invest more because the interest rate is high. So they will be able to enjoy the benefit of savings at that point in time. The third one, the rate of economic growth. The rate of economic growth. If an economy is growing, firms need to increase their investment to meet up the needs of consumers. The idea of investment is linked to change in output or income. So if the economy is growing, firms need to invest more so that they can meet up the needs and wants of customers. Because if the economy is growing, it means the income level is high, the demand in the economy is increasing. So firms are supposed to do what? Invest more so that they can meet up with the needs and wants. They have to accelerate their output. They have to accelerate their investment. That goes about the acceleration theory here, which is investment on a period of time with the acceleration period into the change in income minus the change in income minus 1. So at that point in time, firms have to invest more so that to meet up with the needs of customers. We call it acceleration theory. So if the economy is growing, firms have to accelerate their investment so that they can meet up with the needs and wants of customers. The next one is the cost on investment, the amount spent on investment. So the cost of investment is also an important determinant of investment. If the cost of production are high, the return on investment becomes less. The return on investment becomes less. So firms might feel reluctant to invest. What I'm saying is this: if the cost of investing is high, that means you have to spend so much money to produce goods and services. That means your cost is high. You might feel reluctant to produce more. Because then you produce more. Because your profit will be less. Your cost is high. Your cost on investment is high. Then you might not be able to make more profit, except if you can transfer the cost to the price you are selling. And transferring the cost to the price you are selling might also reduce the demand for your product. So firms might feel reluctant to invest because of increasing cost of investment. Then business expectations and confidence. If businesses are expecting that sales will increase in the future, they expected an increase in sales in the future, they will invest more in capital goods now. They will invest more because they know in the future they're going to sell more. Also, if enough firms are confident about the future, the investment is likely to increase in such economy. If a lot of investors they are confident that in the future they're going to make more sales, they will invest more. So at that point in time, a lot of investors will come into the economy because they believe the future is brighter. The availability of credit. For the availability of credit, here I wrote, credit is based on interest rates. However, if the interest rate is low, credit becomes cheaper and firms will find the motivation to invest further through credit facility. The level of credit you get is determined by the interest rate. So if interest rate is less, credit facility becomes cheaper, then a lot of people will take credit for investment. But if the interest rate is high, credit facility will be expensive. A lot of businesses will not want to take credit for investment. And the last one, influence of government and regulation. Government also takes part. Government also play an important role in the investment of the economy. Because government have policies that they can make, like taxes, like fiscal policy, like monetary policy, to encourage investment. So if these policies are in accordance with investors, if these policies are friendly with investors, they will want to invest more. But if these policies are difficult for businesses or investors to abide with, they will stop investing. That is the point about government influence. So government will come up with subsidies, which is part of a fiscal policy to encourage investors. Government will come up with tax cuts. Government reducing the taxes paid by firms in terms of profit they make. this will increase, or this will motivate, or becomes an incentive for businesses to invest more. So if taxes are increasing, investment will fall. If taxes are less, investment will increase. If subsidies is increasing, investment will rise. If subsidies are coming down or falling, investment will fall. So these are government policies that could also influence investment in the economy. Is it clear?